InvestSense market commentary for the second week of August 2025. And it was another fairly quiet week, actually pretty positive in the last few days. And I listened to a lot of podcasts, and one of the things I keep on hearing recently is how surprised people are at how sanguine markets are. So the last 6 days or so, and apologies for late service on this one, we've had a few things going on in the last few weeks, but hopefully normal service will resume next week. Anyway, back to the present. So markets are up a few percent over the last few days. It seems like the CPI print, which was kind of, there was parts of it the markets could have had issues with, but overall it was in line with expectations. Inflation seems to be creeping up. But it's maybe things on the trade side where, perhaps the news has gone from, not great to maybe a little bit better. More about that in a minute. But either way, markets have been going up. Now, the other thing that will fold in there that we'll delve into a little bit deeper is actually the impact of liquidity. Whenever markets are doing something that people don't understand, quite often it's liquidity. It's things happening under the surfaces, trade flows, what central banks are doing, etc. And that's where Andrew Hunt is particularly useful. And in the what we're working on segment of this newsletter, we talked to Andrew Hunt about some of those things, and in 2 weeks we're going to have a deeper dive on just that. So back to the present, and a case in point, Japan up 7%. Now, there has been some good news, some good corporate news, some good corporate results, and also wage inflation is on the up, which is something that Japan has struggled with for 20 years. But also you've got to, be careful what you wish for. There's signs of a slightly imbalanced economy there, but also 7%. The facts don't seem to really corroborate that, so maybe liquidity is the smoking gun. And the reason why I zero in on Japan, not just because it's up by so much in the last week or so, is that it is a lightning rod for liquidity. And we've seen that again and again on both the downside and the upside, like August last year with the unwinding of the carry trade. So that's something to bear in mind. But back to the good news. Look, the US reporting season, most companies have reported, especially all the important big ones. Big tech have had another storming reporting season. So you look at information technology, the AI spend ramping up, and earnings and revenue up by 20%, and it beat expectations. On the other hand, you could say that it's decelerating, and there is evidence of that. And in the broader economy, outside of financials, for instance, there's more evidence of deceleration, and the exception there being the banks. The banks are doing relatively well, coming off a low base, and also perhaps being favoured as having a domestic focus by investors. So that inflation print that I mentioned before, that's probably the biggest news of the last few days. But you can see that blue line, goods prices actually creeping up, and that's undoubtedly tariff related. There wasn't an awful lot of guidance or commentary about tariffs in the US reporting season, and that's probably because a lot of CEOs don't want to stick their head above the parapet. So from an inflation point of view, it's the sort of thing that could have been taken either way. The market chose to take it reasonably well. And as I said, probably that sort of, there's a lot of uncertainty around, but there's a little bit less than there was. So Japan again, the tariffs there still remain relatively high, but they've come down a lot, especially for automobile manufacturers. And you can see that around the traps, some of the deals that have been done in the last few weeks. Europe not very happy, but at least there's a little bit of uncertainty. And you can see there in this chart from Hunt Economics that actually it's come down from its peaks. But still, that level of policy uncertainty is still relatively elevated. So when you look at how things have landed year to date, actually reasonably positive. Global small caps up by 20%, the Nasdaq and US up by 15%, and other markets up by highly creditable 10%, and the ructions of Independence Day seem to be long in the rearview mirror. But it's difficult to argue that actually we're in a better place from a world trade point of view, especially than we were at the beginning of the year. And this is hot off the press from Hunt Economics, and what it shows here is capital movements across US borders, and you can see there's been an upwards trend that's actually spiked in the last few quarters. And if we go into that in a little bit more detail, we can see in line with that, and perhaps as you'd expect now, knowing this, but not what you would have expected at the beginning of the year or even in April, is the US current account deficit has ballooned out. Now, a lot of this is people forestalling US tariffs, bringing things forward. So you've got to ask how sustainable that is. But that's actually actually sort of supported trade flows and the US economy to a large extent. And then when we look at what that means for capital flows, well, it means that we've had one of the biggest periods of capital flows into the US, very much not what's in the news, not what people are talking about, and not what they expected. So perhaps this explains the unexpected nature of markets and why people are finding it a little bit difficult to explain. Lastly, and maybe signs of a turning point here, the other thing that's been talked about is the sort of fiscal ease. The Treasury General account is probably the easiest prism to look at it through. There's other more important ones, but you can see this downward slope. And if you're talking to clients, one of the things you can say is that this is like the sort of government's checking account, and there was a reasonable amount in the account when Trump came into power, and since then, perhaps trying to sort of ease the way with these difficult policy discussions, there has been, and also there's been things to pay for, and that seems to be increasing. And you've seen the TGA move down. There's been other measures of fiscal ease, but you can see that just start to tick up. And the thing that's on the market horizon at the moment, and the thing that we will be discussing with Andrew over the next few weeks, is with the big beautiful bill, there's definitely an easing bias to this administration, and this stuff's got to be paid for at some point, and the US is already highly indebted. And what happens, who's going to pay for this? In the past, it's been China buying US treasuries. Now, as we discuss it with Andrew today, there is a bias probably to issue at the short end, because last week one of the things that another thing that the market could have had issue with was the fact that there was a Treasury auction which didn't go terribly well, and Scott Bessent at the Treasury will be looking at this very, very closely. So they're probably going to try and issue at the short end. The main buyers there are probably going to be the banks. So this is why Andrew said, look, we've had a preemptive discussion, but we're going to have a deeper dive in 2 weeks where we'll know a little bit more. And what he's seeing is a little bit of a turning in the tide, but things are still on a knife edge. We've got this inflationary or deflationary outcome. And one of the things he said to watch out for is what the US commercial banks do. If they're in expansionary mode because they think the economy is going well and the yield curve sleeping and is steepening and they can make money from that, then they may be one of the key funders of this deficit-driven issuance. But if they go into contractionary territory, we might see the beginnings of a credit crunch. And that's the sort of thing that might be coming into focus in the next few weeks. And that'll lead to various other scenarios. One could be, it could look like sort of quantitative easing, like the post-GFC period, and we might be kicking the can down the road a little bit more. Or we could get a bit of a liquidity squeeze that turns into a credit crunch. So watch out for high yield, watch out for other measures like CDS of liquidity and financial risk decreasing. And then beyond that, there's another two scenarios, because either things could just sort of muddle through and stay around there, or they could go through to other scenarios depending on what the first stage looks like, where we have a full-on inflationary surge because the government eases into it, adopts things like yield curve control, trying to pin yields down, or we could have some sort of policy whiplash and things could get a little bit more rocky. So lots more to talk about actually in 2 weeks. What we're going to talk about next week is probably with Tim Binstead, head of Australian equities. And one of the last things I'll mention about what's happened in markets, which is particularly important for Australians, and it kind of tells you something also about the pricing in markets. CBA had an okay result, but it was actually down 5% yesterday. And this is a real focal point for everyone in the market, because it's another of these things that people can't quite explain. They can't get their mind around the valuation of CBA, and there's a sense that what can't persist at some point won't. So we'll be diving into that in a little bit more detail, and we'll also have a fair few of the local results to discuss with Tim next week. Look forward to talking then. Thank you.